Okay, can you see my screen and my voice? Can you hear my voice clearly and can you see the screen clearly?
Yes, sir.
Okay, now I'm going to start the session. Today we are going to, or let's wait for 1-2 minutes because it's still 7:29. So let's wait for the others for just 2 minutes or 3 minutes.
Recording. കൊടുക്കാനാണ് വേറെ.
Okay, I'm just going to wait for 2 minutes more and then I'm going to start the session. Okay, I'm going to start the session now. Today we are discussing project cost management, chapter 7, and this is knowledge. This is the knowledge area. Okay, this is the knowledge, one of the knowledge area from the PMP PMBOK. Okay, so what are the learning objectives? Here, the learning objectives in this chapter are understanding the importance of project cost management. Okay, we are going to understand what is the importance of project cost management and the basic project cost management principles and concepts and terms, and the process of planning cost management. And you are going to discuss the different type of cost estimates and methods for preparing them. And also we are going to understand the process of determining a budget and preparing a cost estimate for a project, and understanding the benefits of earned value management and project portfolio management to assist in cost control. Okay. So what is cost and what is project cost management? The definition of cost is a resource. Cost is a resource sacrifice or foregone to achieve a specific objective or something given up in exchange. So it means something that is being given to us in exchange, or it's a resource sacrifice. So cost is a resource. It is basically a resource sacrifice or foregone to achieve. So it means you sacrifice some resource to achieve a specific objective, or you give something in exchange, is called a cost. Costs are usually measured in monetary units like dollars. So what is the meaning, what is the definition of project cost management? Project cost management includes the processes required to ensure that the project is completed within an approved budget. So basically the cost management ensure that the project is completed within an approved budget. Okay, so there is an approved budget and the project is completed. The cost management ensures that it is completed within approved budget. Okay. So project cost management includes the processes involved in planning, estimating, budgeting, financing, funding, managing, and controlling costs so that the project can be completed within the approved budget. Again, it's the same definition. It means in cost management, there are processes which is like estimating, planning, estimating, budgeting, financing, funding, managing, and controlling costs. So to achieve the project, objective within approved budget. Cost management processes. So there are 4 processes in cost management, which is plan cost management, estimate cost, determine and control cost.
Excuse me, sir. Can you please tell them to mute their microphone?
Can you please mute the mic, please? Russell, can you please mute the mic?
Oh, sorry.
Okay, please mute your mic, okay? Please. Thank you. Okay, so there are 4 processes in cost management, which is plan cost management, estimate cost, determine budget, and control costs. So we are going to study each of these process with an input, tools and techniques and all. Hello guys, can you please mute the mic? Actually, because everybody is listening, so. Okay. So we are going to study each of these process with an inputs, tools and techniques and output. Okay. So here is an overview of the project cost management. Like you can see here, the plan cost management, and then the estimate cost, determine budget and control cost, which for each of these there is inputs, tools and techniques and output. Now, the key concept here is the project cost management should consider the effect of project decisions on the subsequent recurring activities of using, maintaining, and supporting the product, service, or result of the project. For example, limiting the number of design reviews can reduce the cost of the project, but could increase the resulting product operating cost. Here you can see, if we limit the number of design reviews, it can reduce the cost of the budget of the project, but it can increase in result, produce the operating cost. So it means the operating cost will be increased. Why the operating cost will be increased? Because since we did not review the design carefully, so there might be some mistakes in the design which is not reviewed. So we save some cost there. But actually, once this project is in operation, the cost will increase because there might be some design errors. And with this design errors, it needs rectifications and then again demolishing and then again reconstruction. So that's why the cost is increasing here. So we have to be very careful here how to manage the cost of the project. Another aspect of cost management is recognizing that different stakeholders measure project cost in different ways and at different times. For example, the cost of an acquired item may be measured when the acquisition decision is made or committed, the order is placed, the item is delivered, or the actual cost incurred or recorded for project accounting purposes. So again, why we are managing the cost again? Because we want to see and recognize different stakeholders, and we want to measure different stakeholder that different stakeholders are occurring the cost from the project in different ways at different times. So we want to measure that. So to measure that, we want to have this project cost management. We want to we want to be very specific here. So that's why the costs occur due to different items like the acquisition decision made or committed, the order that is placed, the item that is delivered, the actual cost that is incurred or recorded. So that's why it is also necessary for the accounting purposes. That's why cost management is necessary to measure each and every aspect of the stakeholder, their participation in the project, how much the order the item is ordered, how much of the project material is delivered. So for that reason, we need cost management. What are the trends and emerging practices nowadays? Nowadays, the emerging trends are the expansion of earned value management to earned schedule. Okay, and this is one of the aspect here because they are now converting from EVM, earned value management, to earned schedule. The other aspect is cost management is recognized that different stakeholders measure project costs in different ways and at different times. For example, the cost of an acquired item may be measured when the acquisition decision is made or committed, the order is placed, the item is delivered, or the actual cost is incurred or recorded for project accounting purposes. Again, you know, the other aspect is like different stakeholders involvement here. The different stakeholder involvement is in different ways, in different timings. Each stakeholder is participating in different timing and its cost is different. That's why we want to analyze that the stakeholder participation, their costs incurred. We are going to analyze this all in project cost management. What are the trailing considerations? The trailing considerations nowadays are like knowledge management, estimation and budgeting, earned value, use of agile approach, and governance. So what is basically is knowledge management? It does the organization, we want to see does the organization have a formal knowledge management and financial database repository that a project manager is required to use and that is readily accessible? It means do we have knowledge management in our project? Do we have formal knowledge management or financial database that if a project manager requires some time and it is readily available to the project manager? This is one of the trailing considerations nowadays. And estimation and budgeting, like does the organization has existing formal or informal cost estimation and budgeting related policies, procedures, and guidelines? So it means the organization has formal or informal estimating techniques or budget related policies or guidelines. And earned value management, EVM, it means if the organization is using EVM to manage the projects, and if there is any agile approaches, we are using agile approaches like agile methodologies in managing the different projects. Like how does this impact cost estimating? So agile is used basically in adaptive life cycle, not in predictive life cycle. Adaptive life cycle are mostly used in software industries and software manufacturing companies. So they are using the agile approaches. And governance, it means does the organization have formal or informal audit and governance policies, procedures, and guidelines? It means do we have formal or informal audit or any governance policies here or procedures or guidelines? So these are the trailing considerations and we have to consider this. An agile consideration is like projects that with high degree of uncertainty or those where the scope is not yet fully defined may not benefit from detailed cost calculation due to frequent changes. Instead, lightweight estimation methods can be used to generate a fast high-level forecast of project labor cost, which can then be easily adjusted as change rises. Detail estimated or reserved for short-term planning horizons is just a time fashion. So those projects that has high degree of uncertainty or where there is scope, where the scope is unknown here, may not benefit. They may not be benefit from these detailed calculations because there may be frequent changes here. Because some project is uncertain and their scope is not defined. So we did some cost calculations, but that projects is not going to be benefit from these cost calculations. So instead, there is lightweight estimation methods can be used to generate a fast high-level forecast of project labor cost, which then can easily be adjusted as change rises. Detail estimated are reserved for short-term planning. So it means for short-term planning, we can use lightweight estimation methods. Or in case where high variability projects are also subject to strict budgets. It means if there is a project with high variability, it means strict budget should be there. Strict because the scope and schedule, we know the scope and we know the schedule, so we can adjust to stay within the cost constraints so that our project is within the cost constraints. It does not exceed the cost constraint, especially in agile. Okay. So the plan cost management, what is the plan cost management? This is the first process here. We are going to discuss in cost management. Plan cost management is a process that establishes the policies, procedures, and documentation for planning, managing, expanding, and controlling project cost. Okay, so to control the project cost, it needs the plan cost management needs policies, procedures, and documentations for better planning and for better managing and expanding and controlling the cost. So the benefit here for this process is that it gives us direction and guidance that how the cost will be managed throughout the project, from the project start and until the end of the project. And what are the inputs, tools, and techniques? Here we can see again the same like project charter, project plan, project management plan, schedule management plan, risk management plan. It's part of the project management plan. Schedule management and risk management is part of the project management plan. And there is enterprise environmental factors and then OPA, organization process assets. Then there are tools and techniques to execute these inputs, like the expert judgment, like the consultants and data analysis, and then we can have meetings to generate and reach to the cost management plan. So, okay, now first thing is the inputs. The project management plan. What does the project management plan includes? It includes schedule management plan, risk management plan, scope baseline, schedule baseline, or other information. What is schedule management plan? Schedule management plan is basically the activities in the baseline program or in the schedule that is developed and that will be monitored and controlled in the schedule. The schedule management plan, like it provides the processes and controls that will impact cost estimation and management. So, okay, schedule is necessary. In any project, the schedule is necessary because based on the schedule, we know how much % of progress to be achieved in each month. So based on those plan values, we know it is giving us the cost indication that, okay, on this particular month, the cost will be more. Okay, risk management plan. What is risk management plan? It provides the approach like to identify and to analyze and monitor risks. The risk management plan provides processes and controls that will impact cost estimation and management. Okay, if there is no risk management plan, so we should be having risks to manage and we cannot manage and control our costs. So it is necessary to have a risk management plan in the project. Then there is a scope baseline. It is just a scope statement and work breakdown structure details for cost estimation and management. So this baseline, scope baseline is necessary and it's part of the project management plan. And there is schedule baseline. The schedule baseline defines when the project cost will be incurred. So as I told you, each month in the schedule, we have plan values. So those plan value will show us the high plan value will show us like high cost plan for those particular months. And other information like schedule, risk, and communication decisions from the PMP project management plan. And the other input is project charter. A project charter is basically the summary, it provides us the summary budget for which the detailed costs are developed. So we have the summary of the budget for which the detailed costs are prepared, and it's also part of the project charter. And project charter also define the project approval requirements, like the influence that will influence the management of the project costs. So it defines the project approval requirements that will influence like the management of project costs, how this cost will be approved. So project charter also give you the indication how this cost will be approved on monthly basis, on monthly payments. Okay, the third input is enterprise EEF, or I can say enterprise environmental factors like the organization culture, structure, and that can influence the cost management and their market conditions. We should know the market condition, what product, service, and results are available in regional and global market, and their market conditions and their value in the market in regional and global perspective. And then current exchange rates for project cost source. It means we should have the current exchange rates for the cost that is coming from like we are buying some materials from the other country, and published commercial information such as resource cost rate. So we should have published commercial information for the cost rates. Okay, then the fourth one we have OPA. I can say organizational process assets. It includes like the financial control procedures, like the time reporting required expenditure and disbursement reviews, and accounting codes and standards, contract provisions. And then there is historical information and lesson learned knowledge bases. And then we have financial databases, and then existing formal, informal cost estimation and budgeting related policies, procedures, and guidelines. So we have like all these formal cost estimation, budget related policies, procedures, and guidelines. And we have the historical information and lesson learned knowledge bases of the cost exactly, of to be very specific here, and financial control procedures, that is time reporting, required expenditures, and disbursement reviews. Okay, now I'm going to go for, because since we discussed the inputs for this plan cost management, now I'm going to discuss the tools and techniques. So what are the tools and techniques to execute these inputs? We have expert judgment, data analysis, and meetings. So basically the expert judgment gives us like the information, historical information, and variable insight about the environment and the information from the previous similar projects. So it gives us like from the different historical projects that we, the experts will give us an indication that how much budget cost was that for that particular project. And we have data analysis, like which is we can say alternative analysis, like we can involve choosing strategic options like to fund the project, such as we are self-funding or with equity, like with stakeholders or with shareholders, not stakeholders, with shareholders. So it's called self-funding with equity, or funding with debt. We are funding this project with loans. And the cost management plan, like the detailed ways to finance project resources, such as purchasing, renting, or leasing. And we have like the meetings to see and to discuss how to properly prepare a cost management plan. Okay, now we have outputs, and which is the cost management plan. So the cost management plan is a component of the project management plan. It will describe us how the project cost will be planned, structured, and controlled. So after tools and techniques, we have the cost management plan, and it will show us how to plan, structure, and control the cost. So cost management plan can establish the following, like the unit of measure, level of precision, level of accuracy, and organization procedure links. Unit of measure, we know for each item there will be unit of measure, and level of precision is the degree to which activity cost estimate will be rounded up or down. Okay, and then there is level of accuracy, like the acceptable range is less than 10% or it is greater than 10%. And then organization procedures, like the work breakdown structures, like the framework for the cost management plan. So in every work breakdown, we will have the summary cost, and that cost will highlight to us in which particular area there is more cost, like especially the MEP items, like the HVAC, or you can say the chillers, they have large costs. So these work breakdown structures gives us indications that, okay, here the cost is more. That's why this work breakdown structure is necessary in the cost management plan. And then we have the control thresholds, which is part of the also the cost management plan, like the variances, the threshold for monitoring cost performance, like maybe specified to indicate an agreed amount of variation to be allowed before some actions need to be taken. It means we have thresholds. We have control thresholds, like which will indicate like those agreed upon amount of variation. Like we will say, okay, this change is acceptable or this change is not acceptable. Then there is rules of performance measurement, like earned value management. So there is some rules. There is rules for especially the EVM, which will say, okay, this is the performance measurement rules, and this is how we are going to measure those. And there is reporting formats, like the formats and frequencies of various cost reports that are defined in our reports. And there is process description, like each of the other cost management processes are documented. All these processes are documented. And then there is additional details like about cost management, which includes like description of strategic funding choices. Like we prepare a strategic funding choices. Okay, let's say for example, we are like, let's say for example, a project is financed by someone else who is the owner, but he will write down in this funding choices that, okay, after some time, if I will not have some enough source of funds, so I will go for bank loans to fund the project. And there is procedures to account for fluctuations in currency exchange rate. So we have procedures to account those fluctuations also. And then we have project cost recording procedures also. So these are the outputs. Then the second process is estimate cost. So after plan cost management, the second process is estimate cost. What is estimate cost? Now we are going to estimate. It's the process of developing an approximation of monetary resources needed to complete project activities. Okay, so it is going to approximate. It is going to develop an approximation of monetary resources. And the key benefit of this process is to determine the amount of cost required to complete the project. So this will benefit the process, like to determine the amount of how much cost is required to complete the project. So basically, we are estimating the cost, and after the estimation, we will have the cost that, okay, this is the proper cost for this particular project, which is detailed here, and we have studied it in detail. That's why we come up with accumulated cost. Now, cost estimates are predictions that is based on the information known at a given point in time. So it is also give a prediction that at any given point, how much the cost will be incurred to the project. And it also gives us the identification and consideration of costing alternatives to initiate and complete the project. And the cost estimation are generally expressed in units of some currency. The accuracy of project estimate will increase as the project progresses throughout the life cycle. For example, a project in the initiation phase may have a rough order of magnitude estimate in the range of 25% to 75%, and the budget estimate, which happens during the project planning, at the range of 10 to plus 25%, minus 10 to plus 25%, and later in the project, as more information is available, definite estimates are and could necessarily the range of 5 to 10%. It means we are reducing the inaccuracy from 25 to 75% to 5 and 10%. Okay, so why? Because after some time we will know in detail each and every activity. We will know the real scope. We will know all the details of the project, even the risks. So that's why our accuracy will be very definitive, and it will narrow down to 5 to 10%. Okay, what are the type of costs? There are direct costs, indirect costs. What are the direct costs? Those costs are directly attributed to the work on the project. Like the cost that is incurred directly to the project is called direct cost. Like the team travel, team manages, labor cost, machinery cost, direct labors, okay, direct staff. Those are direct costs. What are the indirect costs and overhead items? Are costs incurred for the benefit of more than one project. It means indirect costs are like, let's say, for example, for any project, if the project is being supported from the head office, so those head office people, they are termed as, or they are defined as indirect costs, because those head office people, they are managing 4 or 5 projects, but they are also managing this particular project. So it means the share is there for this project. So that's why it is an indirect cost. Okay, and there is variable cost. The cost change with amount of production or amount of work, cost of materials, supplies, and wages. So that's if the cost changes like with the amount of production, like cost of materials, supplies, and wages is called variable cost. Right? So for example, material costs, the material costs increase and decrease within some specified time. And fixed costs, these costs does not change like rent and setup and utilities or site offices or lease of land for site offices. So those are fixed costs. What are the inputs, tools, and techniques? The input tools and techniques are like here you can see we have again project management plan, project documents, EEF for inputs, and tools and techniques are like we'll add an analogous estimation, parametric estimation, bottom up estimation, and some data analysis and decision making. We will vote here. Again, what are the output? We have cost estimate, basis of estimate, project documentation updates, and assumption log, lesson learned, and risk register. We are going to discuss each of them. Now, what are the inputs? Cost management plan. The cost management plan defines how project cost will be managed. So, okay, it will show us how the project will be, how the cost will be managed, and how it will be controlled. And it is also give us the level of accuracy to estimate activity cost. What is quality management plan? It describes the activities and resources necessary for the project management to achieve the quality objective. It means there is quality objectives, and we are going to achieve it. So it means we should keep this in our mind that okay, quality management plan is there, and we should consider this while estimating our cost. And then there is scope baseline. We know the scope baseline like from the project scope statement, like reflect funding constraint by period for the expenditure of project funds or other financial assumptions and constraints. And then we have work breakdown structure, which shows us what are the work breakdowns for each of those scope baseline items. And then there is work breakdown dictionary. We have like the other input like project documents, which is lesson learned. And lesson learned, from the previous projects, we should have the lesson learned register, which will show us like for the same particular project. And then there is resource requirements, like to identify and estimate the types and quantities of resource required for each work project or work package or activity. So we should know and identify what are the resource requirements here. And then there is project schedule and risk register. Project schedule is give us the amount of time in which the resources will be applied and the factors that is going to be determine the project cost. And then the schedule activity resources is going to give us the respective durations and the key input to these processes. And the risk register will give us the risk that is going to occur, or it is the prioritized risk for this particular project, which will give us the detailed information for the estimation of the cost. And then there we have another input like risk register, which is going to give us the general rule, like the project experiences as a negative risk event, like the near-term cost for the project, which usually increase, and there will be sometimes delay in project schedule. So it will give us the risk that is associated to this project. And then EEF, enterprise environmental factors, will give us the market conditions and published commercial information. Okay, and then there is OPA, organization process asset, which is like cost estimation policies and cost estimation templates, historical information, and lesson learned. And then we have, these are all our inputs. So this is all the inputs to the estimation of cost. Okay, now to execute these inputs, we need tools and techniques, and these are the tools and techniques to finalize and to reach to the when we will do the tools and techniques, we will reach to the output. Okay, what are the expert judgment? Here we need expert judgment. We need consultants. We need cost consultant here to guide us, to give us historical information to prepare, to estimate the cost. And then we have analogous estimation. What are analogous cost estimation? Like such as the analogous cost estimation uses the values such as scope, cost, budget, and duration, or measures of scale such as size, weight, and complexity from a previous similar project. So it means analogous means previous similar projects. So from previous similar projects, we are going to estimate how we should estimate the cost here. And analogous cost estimation use historical information again and expert judgment. it is generally less costly because if we have some previous projects information available to us, so it means this estimation is less costly and it is less time consuming again. This technique is less costly and less timely again because it will not take much time here. And then another estimation is parametric estimation, which use statistical relationship between relevant historical data and other variables. As I discussed before, the analogous estimation, which we are using to estimate the cost based on the previous similar projects, but here we will estimate the cost based on the previous similar projects, but we will add the statistical information. We will add statistical formulas to estimate the cost, like the example, for example, the square footage in construction. Okay, and then there is bottom-up estimation. Bottom-up estimation is a method of estimating a component of work. It means we are going to estimate based on each detail of work, item by item, item by item. We are going so much in detail that we will calculate the cost from the market in detail, item by item, and then we are going to accumulate the costs at the summary level. The detailed cost is then summarized or roll up to the higher levels. It means it will be estimated to the higher levels from the detailed one. And the cost and accuracy of bottom-up estimation are typically influenced by the size and complexity of the individual activity or work package. Okay, and then there is 3-point estimation, which is called most likely, optimistic, and pessimistic. I will recall the formula. The recall, this is the, again, recall for the formula that is, as we discussed before in our previous time knowledge area, we discussed that about the 3-point estimation, the most likely, optimistic, and pessimistic formulas. Okay, and then there is data analysis, like the alternative analysis, reserved analysis, and then the cost of quality. What are alternative analysis? A technique to evaluate identified option in order to select which option or approach to use to execute and perform the work. It means we are going to do the analysis here. We are going to see which analysis is best for our project. Like which analysis is best for our project. Okay, I received one message here. Let us see. Parametric and bottom up to be explained again, please. Okay, let me go back. Parametric and bottom up. This is analogous estimation. Let me start from the analogous estimation. Analogous estimation means we are estimating the cost based on the previous similar projects. So what will happen if we estimate the cost based on the previous similar projects? It will consume less time and it will consume less cost from us to estimate by analogous estimation. Analogous means previous similar historical data. Parametric means an advance to analogous estimation. We will use statistical relationships in analogous estimation to calculate parametric estimation. It means parametric estimation is equal to analogous estimation plus statistical formulas. It is going to give us parametric estimation. And then the bottom-up estimation is we are going to calculate item by item from a detailed level of estimation, item by item, and then we are going to reach up to roll up to the summary level. And this is how we are going to estimate in bottom-up estimation. I hope it is clear. Arun, it is clear? Mr. Arun, is it clear? Okay. Then there is 3-point estimation. There is a formula for 3-point estimation. There is 3 formulas. Okay, but it is estimated based on, like, we will like see, okay, this is most likely condition, this is optimistic condition, and this is pessimistic condition. Optimistic means we are more positive to one of the item, to one of such one of our approach, and then we are very negative, which is called pessimistic, and this is most likely means the realistic. So we are going to use the 2-3 formulas to estimate based on 3-point estimation here. And then there is data analysis. Data analysis is used like a technique to evaluate identified option in order to select which options or approach to use to execute and perform the work of the project. An example will be evaluating the cost, schedule, resource, and quality impacts of buying versus making a deliverable. It means we are going to analyze our techniques, that which technique is best to use to evaluate or to estimate the cost. And then we have reserves analysis, which we'll use in tools and techniques, contingency reserves and management reserves. What is contingency reserves? It is also called an uncertainty cost. It's called uncertainty cost, or the budget within the cost baseline that is allocated for identified risks. Since we know the risk, so we will allocate the cost for the identified risks, which are accepted and for which contingent or mitigating responses are developed. It means contingency reserve means we are allocating the cost for those items, for those areas where we see that there is uncertainties and there is risks. So we will add additional costs to those items. And then there is management reserves, amount of budget with for management control purposes or reserved for unforeseen work. It means we will put the management costs here. Management costs are intended to address unknown and unknowns that can affect a project. The management reserves is not limited in the cost baseline, but is part of the overall project budget and funding requirements. Okay, then there is cost of quality. We will use another tools and technique which is called cost of quality. The cost of quality is based on the assumptions about the cost of quality. Then it includes evaluation, the cost impact of additional investment in conformance versus the cost of non-conformance. It means, since if we have some NCRs, non-conformance reports, highlighted in our previous projects, that okay, this quality is not achieved. So we are going to evaluate the cost impact of additional investment in conformance versus the cost of non-conformance. It means if the additional investment is in conformance based on the cost of non-conformance, that it was not conformed before to the cost of quality. It can also include looking at short-term cost reductions versus the amplification of more frequent problems later on the project life cycle. So it means it includes the looking at short-term cost reduction versus the implication of more frequent problems in the product life cycle. This is for the agile. We are talking about agile. If I'm using the word product, it means agile. Okay. So in agile, we are using short-term cost reductions versus the amplification of more frequent problems. It means in every iterations, we are looking at the cost reductions versus the implication of more frequent problems. It means in every iteration, we will face some problems, and we are going to assess this before at short-term cost reduction, that what is going to be the short-term cost reductions here. And then we have project management PMIS, project management information system, which is vendor bid analysis and group decision-making techniques. Cost estimation methods may include analysis of what the project should cost based on the responsive bids from qualified vendors. So we are going to assess this based on our qualified vendors, based on our approved vendors list. We are going to get the responsive bids from them to see that to manage our vendor bid analysis. And then there is group decision making techniques which we are going to sit down and we are going to do the voting here. We are going to vote from each of our cost analyst person, and we are going to brainstorm here. And there will be nominal group techniques which will engage our team members to improve the cost, to improve our cost estimation, and to improve the cost estimation accuracy, and to see and to emerge to a good figure here, to a group cost estimation figure here. And then there is the outputs now. So since we did our tools and techniques to execute our inputs, we are going to reach to the outputs, which is activity cost estimates. So we reach the activity cost estimates, which are quantitative assessment of the problem's cost required to complete project work. Cost estimation can be presented in summary form or in detail. Cost estimation are established for all resources that apply to the activity cost estimate. It means all our resources have cost. It includes, but not limited to, direct labor, materials, equipment. So we have a cost for all of our items, like the exchange rates, like the inflation allowance, like the information technology used in the project, like the equipment cost, like the labor cost, like the material cost. So indirect costs and direct costs, all those are calculated in the activity cost estimates. And then we have the basis of estimates. What are the basis of estimates? We have the report that, okay, since we calculate our activity cost estimates based on basis of estimates. So what are the tools and techniques? What are the things that we applied? What are our estimates? What are our assumptions here that we reach to the figure of cost estimate? And then we have project documents updates. And the project document update is like we will update we have updated all our project documents. The third process is determine budget. Okay, determine budget. What is that determine budget? Determine budget is a process of aggregating the cost of the estimated cost of individual activities or work package to establish an authorized cost baseline. It means we have cost estimate. We are going to allocate this to individual activities or work package to establish an unauthorized and not an unauthorized, to establish an authorized cost baseline. So we are going to reach to the cost baseline here. And the benefit of this process is that it determines the cost baseline against which project performance can be monitored and controlled. The project budget includes all the funds authorized to execute the project. The project cost baseline is the approved version of the time phase project budget. It means we reach to the cost baseline, and this cost baseline is based on the schedule. Because in the schedule, it will show us that at that particular month in the project, there will be the budget, the budget will be that much. This will be the value, maybe 5 million, 10 million, 15 million, 3 million of budget is allocated to this particular month, and it will be based on the cost baseline. And the cost baseline is referred to the scope, to the schedule baseline. Okay, now we have inputs, tools, and techniques and outputs for this determine budget. Since we are going to determine the budget, let us discuss one by one. Okay, here is a flow chart. You can see the inputs like the project management plan, project documents, business documents, conduct procurement, and enterprise and organization process assets. And then we have determined budget. Then we are going to reach with project management plan, control costs, and project documents. So the input to determine budget is cost management plan. Cost management plan describes how the project budget will be managed and controlled. Yes. And resource management plan will give us the information based on the travel costs and the unforeseen costs that necessary to estimate the overall project budget. And then there is scope baseline, which includes project scope statement and work breakdown structure, and then the dictionary of the work breakdown structure. And then we have the basis of estimates in inputs like the activity cost estimate that is estimated based on from a low level, from a very detailed level to the high levels. And then we have a project schedule as an input, like which we have the plan start date and the finish date for the project activities, like the milestones and the work packages and the control accounts. And the information is used to aggregate cost in the calendar. So we have the costs based on our calendar. We can have the cost on daily basis even as an input to determine the budget. And then we have project schedule, which will give us the milestones, which will give us the control accounts, which is going to aggregate cost to the calendar periods in which the costs are planned to be incurred. And then we have a risk register, which will also be reviewed to consider how to aggregate the risk response cost. It means we allocate some risk, we allocate some costs to the risk in response to the risk. In response to the risk, we allocate some cost here in our budget. And then we have the input like business case. The business case, like the critical success factors for the project, is included in the business case. And then we have benefit management plan, like it is also part of the charter, project charter. So it will give us the net present value calculations and time frame for realizing benefits and the matrices associated with the benefits. And then we have agreements like applicable agreement information and costs relating to project services or results that have been in place or purchased and included when determining the budget. So since we have all these agreements here, okay, and then yeah, we have OPA, which is like formal informational cost budgeting related policies, procedures, and guidelines. And then we have project cost budgeting tools and then reporting methods. It's part of the OPA. And then we have cost aggregation. Cost aggregation means like we are going to see and cost estimates based on work packages, including which includes the work breakdown structure. So the cost is aggregated on the work breakdown structure. And then we have data analysis, which is called reserve analysis. And then there is expert judgment. And then there is historical information review. So we are going to review again with the historical information. Based on parametric or analogous estimation, we are going to see our project budget we are going to review it based on the historical information from the previous project. Like residential home construction is based on certain cost per square feet of space. Like another complex example is one model of software development costing uses multiple separate adjustment factors, each of which has numerous points within it. And then we have both the cost and accuracy of analogous and parametric models, which can vary differently. So they are most likely to reliable upon some information like historical information, like parameter used in the models, and then models are scalable for large projects, small project, and phases of projects. So this is historical information. That's why the historical information is necessary, okay, to review again our budget based on the historical information from the similar projects. And then we have funding limiting reconciliation, like the expenditure of funds should be reconciled with any funding limits on the commitment of funds for the project. And then we have variance between the funding limits and the planned expenditures will sometimes necessitate the rescheduling of work to the level out the rate of the expenditures. And this is accomplished by placing imposed rate constraint, which means we have funding limitations. Funding limitation means we have provided a document and we have documented it here that okay, that on this particular day the direct investment will be no more and there will be funding for the project based on the bank loans. So we have limited reconciliation here. And then we have financing, like we are going to entail our financing based on acquiring funding for projects like long-term infrastructure, industrial and public service projects to seek external source of funds. If a project is funded externally, the funding entirety may have certain requirements that are required to be met. It means before funding the project, the entity who is going to fund us has the requirements which should be met here. Okay, and then we have the cost baseline as an output now. And the cost baseline will give us the cost based on each particular day, and cost is going to, we have planned costs according to months or according to days of months. Is going to give us the formal cost baseline, and is also going to give us the change control procedures and the basis of how to compare those with the actual results. And it is developed also as a summation of the approved budget for the reference schedule activities. So it's also, the cost baseline is also a summation of the approved budgets for the different schedule activities. So it means this is approved budget now in the cost baseline. So you can see here the project budget components, the total amount versus the project budget component. Like the project budget is the high level one, then the management reserve and the cost baseline is it will take the amount will be less here, and the control account component is again less here. Then we see contingency reserves and work package cost estimates, and then the activity contingency reserve and the activity cost estimates. So you can see here the total amount versus the project budget component. And then we have cost baseline, expenditure and funding requirements, which is cumulative values versus time, which is going to show us how the expenditures are. Like you can see the expenditure are less than the cost baseline. The expenditure should be less than the cost baseline, and we have funding requirements like how much is the management reserves here, and how much is the project budget, and how much we are going to budget at completion, how much the budget at completion will be. And then we have tools and we are going to go for tools and techniques in the cost baseline to create work breakdown structure. Like you can see here, this is a flow chart to create a work breakdown structure here. What is the need assessments? Like you can see it is divided into sub levels here. Okay, like this is value management system project, which has need assessment as level 1, and then standard development, system and engineering and project management. And then we have from need assessment, it is divided again into four levels, like current system audit, requirement determination, alternative development, and system development. Then again, it is divided into 2 sub levels. Here is a cost budget. You can see here how to create a budget. Like see, we discuss here, there is estimation of estimation based on activity, and then it is being estimated based on work packages. Then there is control accounts, then is project estimates. We are going to put the project estimates, then we are going to put the contingency reserves, then the cost baseline is prepared, then a management reserve is also added here, and then we have the final, which is project cost budget. Okay, now this again, that to determine the budget, there is another section here, which is another item here, which is project funding requirement. Like we want to see how much total funding requirements are and how much is their periodic funding requirements, like quarterly or annually from the cost baseline. And the cost baseline will also include the project expenditures plus the anticipated liabilities, and it is going to also show us the funding often occurs in incremental amounts that are not continuous and may not evenly be distributed. And total fund required are those included in the cost baseline plus management reserves. So it means it's also part of the project funding requirements. So the project funding requirement is basically going to tell us how the project is in terms of project cost baseline, project cost in terms of project schedule baseline. The schedule baseline is going to give us, to highlight us on which particular month the project cost will be, how much the planned cost will be based on. So the cost baseline will going to give us the quarterly or annually or weekly or monthly or daily basis project incurred cost on the project, and which is part of the to determine the project budget. And then we have the project documents, which we will update, we will update all our project documents. Then we have now, since we have the project budget, then we are going to control the cost. How to control the cost? We are going to see here in this process. This is the last process of the project cost management knowledge area. Now we are going to control the cost. How to control the cost? The definition of control cost is the process of monitoring the status of the project to update the project cost and manage changes to the cost baseline. It means we are going to monitor the cost based on the project updates, and we are going to see how the changes will affect the cost baseline and how it will be determined, how these changes will be determined. And the benefit, of this process is it provides us the means to recognize variance from the plan. So it's going to give us the variance from the plan in order to take corrective action and minimize the risks. So project cost control include influencing the factors that create changes to the authorized cost. It gives us change requests. It manages the actual changes. It ensures the cost expenditures. It monitors cost performance. It monitors work performance against fund expended. It prevents unapproved changes from being included in the reported cost. It gives us information that appropriate stakeholder for all approved changes. And it also gives us to bring expected cost overruns within expected acceptable limits. So these are inputs, tools, and techniques and outputs to control the costs. This is the flow chart, which is give us like the project management plan, project documents. These are all the inputs, and we have the output like monitor and control project work, and then perform integrated change control and project management plan and project documents. Okay, this is the inputs project management plan, which is again the cost baseline. Then we have like the cost baseline is updated since we have the cost baseline. So we have cost management plan also. And then we have performance measurement baseline, which is like the unvalue analysis. The performance measurement baseline is compared to actual results. So in unvalue management, the performance baseline is compared to the actual results. And then we have project funding requirements. Then we have work performance data, like the information, how the progress, such as which activities have started their progress. So it means we have the performance data now, that on which particular month the activity is being progressed and which particular activity is in delay here. So since we know the work performance from the start of the project, so we can control the cost. This is also an input to the control cost process. Then we have OPA as organization process assets, which is existing formal and informal cost control related policies, which is basically a procedures or guidelines or tools to control the cost, and monitor and reporting methods. What are the monitoring and reporting methods to be used here? And this now, since we have all the inputs to control the cost, then we are going to assess this. We are going to evaluate this based on tools and techniques. And what are the tools and techniques? The unvalue management. It's basically a methodology to combine schedule, cost, scope, and resource measurement to assess project performance and progress. And it is a method of performance measurement for projects. So the principles of EVM can be applied to all projects in any industry. So these principles are used in all the industries here. The scope baseline with the cost baseline along with the schedule baseline to form the performance baseline, which helps the project team assess and measure project performance and progress. So basically, earned value management. We will use the earned value management techniques to control the cost here, to see budget at completion, to see budget to completion. So from earned value management, we can see budget to complete, budget at complete. So it will be assessed here as a tools and technique here. Then EVM, earned value management, record to cost management, is concerned with the relationship between the formulas like the plan value. Plan value is a schedule and the budget authorized to accomplish that work. Basically, it's a schedule and budget authorized to accomplish that work. For example, if a project has a budget of $100,000 and month 6 represents 50% of the project, but the plan value will be 50,000. So out of 100,000, if the project is like for 6 months, so it will give us the 50,000 plan value. And the plan value is also called budget cost of work schedule. Now, the earned value is the physical work completed to date. The physical work that is being completed to date. For example, if a project has a budget of $100,000 and the work completed to date represents 25% of the project work, so 25% multiplied by $100,000 will give us $25,000 earned value. Then there is actual cost. Actual cost is the actual amount of monies the project has required to date. For example, if a project has a budget of $100,000 and $27,000 has been spent on the project to date, so the actual cost will be 27,000. It means this is the expenditure which is the actual cost on the project. This is the actual cost on the project now. So here is the, let's say for example, the budget at completion is $100,000. Okay, 25% of the project is complete, and month 6 is 50,000. So this is our plan value. What the project should be worth at this point in the schedule? This is $50,000 because this is the total project cost is $100,000. So to calculate earned value, to calculate the earned value here at 25% complete, it means 25% complete multiplied by budget at complete, which is the project value $100,000, will give us the value of earned value $25,000. Here the actual cost, we are going to see how much the actual cost is incurred, which is $27,000, and the plan value at the end of 6 months will be, since this is 50% of the time, so it means 50% of $100,000 is $50,000. So another technique is cost variance. The cost variance is the difference between the earned value and the actual cost. Like for example, for a project that has a budget of $200,000 and has earned or completed 10% of the project. So 10% multiplied by $200,000 is $20,000. So this is the cost variance here. Now, however, due to some unforeseen incident, the project manager has to spend $25,000 to complete. So that $20,000 worth of work. The actual cost of project at that point is $25,000 and the cost variance is $5,000. Thus the equation of cost variance is, so basically the cost variance is earned value minus actual cost. So what is, let me go back here. Earned value minus actual cost. Cost variance is earned value minus actual cost. Earned value is $25,000. Actual cost is $27,000. So $25,000 minus $27,000 will give us 25,000 minus 27,000 will give us $3,000.
2,000.
Yeah, 2,000. Sorry, 2,000. Yes. Okay. So this is how we calculate cost variance here. Earned value minus actual cost. Now these are the some tools, some acronyms used for the term and the interpretation, like the plan value. PV is plan value. EV is earned value. So what is basically plan value? PV. Plan value is estimated value of work planned to be done. Earned value is, what is earned value? It is the estimated value of work actually accomplished. It means work actually done. So the work that is being actually done is called earned value. Actual cost is how much the actual cost for the work accomplished. It means how much is the expenses on the project is called the actual cost. And the budgeted completion is how much did we budget for the project budget, for the total project effort. So it means how much is the budget for the project. So budget for the project is budget at completion. Estimated completion is how do we currently expect the total project to cost. It means how much is estimation at complete, how we currently expect the total project to cost, how much we are expecting here. And estimate to complete is how much more do we expect to cost to finish the project. It means how much more we expect to estimate the cost to finish the project, how much more. And variance at complete is how much more or under budget, how much more or low budget or under budget, how much more or less budget we expect to end the project. So this is variance to complete. Now here, these are the formulas. PV is equal to $100,000 plus $100,000 plus $1,000 plus $1,000. So the plan value is $3,000. We should have done $3,000 of worth of work. Earned value is complete and half done, or 1,000 plus $1,000 plus $500,000 plus $500. So this is basically $2,500 earned value. We have actually completed 2,500 worth of work. It means we completed those works. Actual cost is how much we actually spent. 1,000 plus 1,000 plus 600, 1,000 plus 1,200 plus 600 is 2,800. So it means we have actually spent $2,800. Budgeted complete is, we are saying like 1,000 plus 1,000 plus 1,000 plus 1,000 is 4,000. Our project budget is $4,000. Then cost variance is 2,500 minus 2,800 is equal to minus $300. We are over budget by $300 since it is negative. So that's why we are our budget by $300. Then there is CPI. CPI is equal to $2,500 divided by $2,800, which is earned value divided by actual cost. Earned value divided by actual cost will give us CPI, cost performance index. We are only getting about 89 cents out of each dollar we put into the project. Then there is schedule variance, which is SPI, which is going to give us time-related indications like 2,500 earned value divided by actual earned value divided by planned value will give us SPI, schedule performance index. It means we are only progressing at about 83% of rate plan. Estimate at complete is budget at complete divided by CPI. Estimate at complete is budget at complete divided by CPI. It will estimate us the project will cost around $4,479. And estimate to complete is estimate at complete minus actual cost will give us estimate to complete. It means we need to spend $1,679 to finish the project. Then there is variance at complete, which is $4,000 minus $4,479, which is variance at complete is budget at complete minus estimate at complete. Budget at complete minus budget at completion minus estimated at completion will give us variance at completion, which will show us what we currently expect to be $4,710 minus $4,709 our budget when the project is completed. So this is how the original spending plan is, like plan value and budgeted complete. Then we have actual cost. This actual cost means this is how much the cost has been occurred as of today. And this value estimate to complete will give us how much the project is going to be more, how much more budget. Estimate to complete is how much more cost or how much more forecasted investment is necessary to finish the project at estimation at completion. So you see this line is more than budget at completion. It means we have added estimate to complete plus we are going to reach with estimate at completion. This is cost variance formula. Cost variance is equal to earned value minus actual cost. Schedule variance is earned value minus plan value. CPI index is earned value divided by actual cost. schedule performance index is earned value divided by plan value. So if cost variance is negative, it means we are over budget. And if it is positive, we are under the budget. Schedule variance, if it is negative, it shows us behind the schedule. And if it is plus, it shows us we are ahead of the schedule. CPI is equal to, it is going to show us if we are getting like earned value divided by actual cost. So it will give us some value, which is going to show us this much amount of worth of work out of each dollar spent. Funds are on or are not being used efficiently. It means it will give us greater than one is good, less than. If it is greater than one, it means we are performing well. If it is less than one, we are performing bad. Our CPI is bad here. And then there is SPI. It means it is give us, if it is greater than one, we are ahead of the schedule. If we are less than one, it means we are behind the schedule. See, this is a chart here, dollars against each item. Let's say, for example, this is budget at completion, BAC. Okay, this is earned value, which you can see the chart, the dotted line is below the budget at completion. Okay, so we are going to estimate CV, cost variance, which is earned value minus actual cost. So we have the earned value here minus the actual cost incurred. And then we have SV, which is going to be calculated based on earned value minus plan value. Okay, minus plan value. So we have the formula. So this is how we are going to calculate. This chart basically depicts us the budgeted completion value, then the actual cost. If our actual cost is more than the earned value, it means something is not good. It means we are over the budget. If our actual cost is more than the earned value, we are over the budget. And if it is less than one, we are actually, if the actual cost is less than the earned value, it means we are below the budget. Okay. Then there is calculating the cost performance index, CPI, the amount of work the project is completed per dollar spent on the project. It means per dollar to spend on the project will give us, it is going to show the amount of work like the project has accomplished according to the each dollar spent on the project. In other words, a CPI of 0.93 means it is costing $1 for 93 cents worth of work. Or you could say the project is losing 7 cents. It means we are losing our CPI is, if it's a CPI is 0.93, it means the costing, it means our actual cost is $1. But in return, we are getting earned value of 93% worth of work. It means we are losing 7% of each dollar spent here. So CPI is equal to earned value divided by actual cost. And then we have schedule variance, which is going to show us the difference, which is going to show us the time related technique. For example, here, it's the value that represents the difference between the project was planned and to be at a certain point in time where the project actually is. For example, consider a project with a budget of $200,000 that expect to last to 2 years. So at the end of 1 year, the project budget has planned that the project be 60% complete. There's a planned value for 60% completion equates through $120,000. The expected worth of project work at the end of each year one. So let's say that at the end of the year one, the project is only 40% complete. So the earned value at the end of year one is $80,000. The difference between the planned value and earned value is $40,000. It means the schedule variance formula is earned value minus plan value. So what is the earned value and what is the plan value? The plan value is, the earned value is here. The project budget is $200,000. Okay. At the end of year one, the project has planned that the project has to be 60% complete. The plan value for 60% is $120,000. Okay. So our plan value is $120,000. Okay. Now, at the end of year one, the project is only 40% complete. So our earned value is $80,000. So $80,000 minus $120,000 is minus $40,000, which shows us we are spending more or less Can you answer me? We are spending more, or we are behind the schedule or ahead of the schedule? Now, in this case, we are ahead of the schedule or behind the schedule? Yes.
Behind.
Behind the schedule.
Why we are behind the schedule?
We are negative.
Negative 40,000 only.
What happened, what actually happened here? It means we planned that the end of year one, our project should be 60% complete, right? Right?
Right.
But
Yes, yes.
we end up with 40% complete, right? So our actual is 40%, right? Plan is
Yeah.
60. So we are behind the schedule, right?
Yeah.
40,000 minus 40,000 minus 120,000 is
What it is?
minus
Negative
40,000. So it is negative. It means we are behind the schedule here. Okay, let's say a project has an earned value of 25,000. Actual cost of 27,000. Okay, I'm going to end the session here. Okay, I think I took more than 1 hour, and we are going to discuss this on Friday here. Okay, from control cost. Okay, so we are going to discuss on upcoming Friday. Okay. If
Yeah,
you
yeah,
Okay.
sure.
related to the previous slide, you can answer. You can question in the Friday session. Okay, for the previous
Okay,
slide.
thank you.
Okay, thank you. Thank you.
Thank you so much.
Thank you.
Thank you.